Welcome everybody to WonUpIt Skills Development Training number 10, I believe. We're going to be continuing with the valuation terms and ratio as part of the financial lecture series that we've been doing. So I was giving these presentations at Georgia Tech when I was a student there and part of the investments committee, and we found it beneficial to share the same type of knowledge with people on our campus ambassador program. So today's discussion will be about valuation terms and ratios. Quickly, we're going to go through what we learned last time, and the subtitles are catching up a bit, so there's a bit of a delay over here. All right. What we learned last time was time value of money, right? A dollar today is more valuable than a dollar tomorrow, because with a dollar today, you can do a lot more with it. So we understood the equations behind that and how that works. So please take a look at the previous lecture series if you have any doubts about time value of money. We also went through financial statements like the balance sheet, income statement, statement of cash flow, assets, liabilities, that kind of stuff. So we went through a lot of different high-level terminologies. The 10Q and 10K is very US specific. However, that's like your annual report, which also would exist in the Indian market, and your quarterly report. So those are things that you should tear through for companies that you're interested in investing in. So we're going to jump right into it. Important terms that we want to familiarize ourselves with. TTM, trailing 12 months, that means the previous 12 months from a particular date. YOY, year over year, that means comparing a particular number from last year to this year. MRQ would be most recent quarter, whether that's Q1, Q2, Q3, Q4. FYE is fiscal year ended, followed by the date. So you say, fiscal year ended with this particular date. F5YE is 5-year expected. That comes into a lot of things to do with bonds and yield duration. So you'll see 5-year expected. Price is used as market price of one share. So you see the word price, it generally means market price of one share. EPS is earnings per share. We're going to jump into a lot of what this means, but you need to understand EPS means earnings per share. So we take our total company earnings divided by the total outstanding shares, and we get an earnings per share. And our market cap is simply our capitalization of that company in the market, which means the price multiplied by the outstanding shares. Okay, what is valuation? Right? Who uses valuation? What are some of the most common metrics used when valuing a company? And what are some of the different ways to value a company? This is very pertinent to the financial industry, but also in the startup world. The financial industry is involved across from startups all the way to making investments in bonds and in companies and in portfolio management. So valuation by people in the financial industry are used in many different ways. Startup valuation is slightly different, but a subset of these types of valuations. So the basics of valuation is the procedure of calculating the worth of an asset, security, or company. Let me quickly add in my highlighter. Right, so we can value anything. We can value an asset, a security, a company. We can value a basket of companies. We can value an ETF. They're just adding a value to something and a financial value to it. Valuation is one of the most primary tasks done by investment banks. That's really who the people who are valuing companies is. And being good at providing valuation for companies is an invaluable skill. Being able to understand value, because your way of valuing a certain asset or a company could differ from somebody else's. Then whoever is closer to the valuation of the actual valuation, whether it is today's valuation or a 5-year expected valuation or next year's valuation, those are the people who are going to have some sort of insight, who can leverage some sort of information which would make them some profit in terms of trading a stock or an asset for a company by understanding what the potential valuation could be versus what the valuation is today. So there are 4 main ways to value a company. Comparable companies, that's comps valuation, is one of the most easiest ways to do something, which we're going to be discussing a little bit more about. But basically it means that, okay, if 2 companies are doing the same thing, I know a very solid way of understanding one company's valuation. I'm going to use that valuation to value the other company as well. So suppose company A has released their sales report for that quarter, company B has not. I can use company A's sales and the valuation company A is at to understand what valuation company B might tracking to if they're able to hit the same more or lower number of sales for that same quarter. Precedent transaction, that's called M&A comps. We'll discuss that in a little bit as well. Discounted cash flow modeling, that's DCF. We're going to Not get too deep into that because you need an entire college class to get into it, but Investopedia has a lot of great links around that. And the leverage buyout model, again, which is a little more complicated, and that is something that we're not going to get into too many details about. Again, there's an Investopedia link that you should go to, which is, you just search leverage buyout Investopedia, you get a good link for that. Discounted cash flow modeling, just to really touch on that for a second. It's used to measure the attractiveness of an investment opportunity. Basically, it uses future free cash flow projections and discounts them using a weighted average cost of capital today. So again, a lot of terms you might not understand, but get used to this type of language so you can Google it and understand really what's this all about. Okay, moving on. So some commonly used metrics. One way to value a company is to compare it to its peers, right? So what are the common ways to look at metrics? One is the enterprise value divided by the EBITDA. Now what is EBITDA? EBITDA is earnings before interest, taxes, depreciation and amortization. A price to book value, price to earnings value, PEG ratio, right? Price to earnings growth ratio, enterprise value divided by sales, price to sales ratio. So these are many different ratios we're going to jump into very, very briefly. Okay, so the enterprise value, what is that? The enterprise value of an entire firm, including both debt and equity. Now remember what debt is and what equity is, and you can review the previous lecture slides if you have any doubts about this. So the enterprise value is the market value of equity plus the debt plus any preferred stock plus minority interest minus cash. So why do we take out the cash? Why are we subtracting cash? Because cash is already counted in market value in equity, in theory, right? You can use cash to pay down debt or pay a dividend. So you would not buy a company for its cash. The cash is not why you're buying a company. So we remove the cash to understand the enterprise value of that company. Now, when we say minority interest, what does that mean? That means a significant but non-controlling ownership of less than 50% of a company's voting shares by either an investor or another company. Again, this is very high-level stuff. So just understand what enterprise value as an entity means. It's very unlikely that you're going to be calculating it yourselves unless you get into the financial space. But in terms of investing in companies and being a casual investor and jumping into the space, understand what makes these values tick. All right. So moving on, let's talk about EBITDA. Right? Like we said, earnings before, very important, before interest, taxes, depreciation, and amortization. So it's a good way to evaluate a company's profitability, right? Now EBITDA is revenues minus expenses. Those expenses do not include taxes, interest, depreciation, and amortization. So how much the company made versus how much the company spent, right? But we're not spent to the government or spent towards bank interest. We want to understand that particular company, how profitable is it? And earnings before tells us, that the company's metrics are in a certain positive or negative light before they start owing things out to non-operational services like taxes, interest, depreciation, amortization. It represents the earnings that can effectively service debt, right? So if our company has debt, then these earnings can service that debt and pay that debt off. It eliminates the effects of financing and accounting decisions because one company may be very smart and savvy in how they account for debt and how they account for taxes and depreciation, whereas another company may not be that savvy. But just understanding how much cash flow is coming in versus how much revenue, how much revenue is being generated, how much cash is coming in versus how much is being spent by the company, that tells us that company is, net EBITDA, which is helpful in understanding how they're going to pay off their debt and whether they'll be profitable in the long term. It's a non-GAAP metric, which is very important because GAAP is the general accounting principles that are used, the generally accepted accounting principles that are used, and those principles are regulated by financial bodies. So since this is a non-GAAP metric, it's not regulated by the financial government services. So you have to take this with a grain of salt because companies can be very good at manipulating these type of metrics. Now, what is depreciation versus amortization? So depreciation is a method of allocating the cost of a tangible asset over its useful life. So suppose you buy a computer, right? You're going to depreciate the company's the cost that you paid for that particular computer over the usable life of the computer. So say they're going to use this computer for 5 years, you can claim depreciation on that tangible asset over a period of 5 years. So businesses depreciate long-term assets for both tax and accounting purposes. A decrease in an asset's value caused by unfavorable market conditions. Or you can think about depreciation as how much of an asset's value has been used up. So if I buy a computer, I'm going to use it for 5 years. In year 2, I can say, okay, 2 out of 5 years of that asset has been used up. In 3 years, I'm going to have to buy another computer. Amortization, on the other hand, is the paying off of debt in regular installments over a period of time. A deduction of capital expense over a period of time of an intangible asset. For example, suppose XYZ Biotech spends $30 million on a piece of medical equipment and that patent on the equipment lasts 15 years. This would mean that $2 million of its recorded cash each year is recorded as an amortization expense. Service debt basically means to pay the debt off that you owe. So don't worry too much again about the details, just understand the general concepts. Free cash flow, it's a term you're going to see used quite often. It simply means the amount of free cash a company has. Free cash means that cash is completely liquid, that it can be used in terms of a payment or a loan or anything that the cash can be immediately used for. It does not mean things that are tied up in other, in other assets or liabilities, which would need to be liquidated before the cash can be used. That's the difference between cash that's tied up and free cash. So capital expenditures less operating cash flow. When we use the word less, we mean without or like minus, you can think about it. So capital expenditure less operating cash flow. So capital expenditure are the funds a company uses to upgrade its physical assets, right? The formula to calculate this is your EBIT, earning before interest and taxes, into 1 minus the tax rate, right? Plus depreciation amortization. Remove your changes in working capital, remove your capital expenditure, and you get your free cash flow. Again, don't worry too much about the math behind all of this. You just need to understand what goes into it and how these different components affect a company's free cash flow. You can have all this in a cheat sheet, while you are evaluating a company. And the more companies you evaluate, the more you'll understand, okay, why does one company's free cash flow look like a certain way, whereas another company's free cash flow? And having a lot of free cash on hand is not necessarily a good or a bad thing. It means that a company can make quick decisions with their cash, or it means that the cash is not being used or not being invested back in the company. And why is it being held as free cash and not as an investment? So working capital is your current assets minus your current liabilities. Why do we use tax rate of 1 minus tax rate? This is a question that I'd like you guys to think about. Why are we not just using the tax rate, right? And why do we subtract changes in net working capital and capital expenditures, right? We want to understand these types of questions when we jump into the details. But for right now, keep this very high level and think about this as your entrance to learning more about these topics. And again, Investopedia is a very good link into extreme details about these particular concepts. Other important ratios to understand is your enterprise value divided your EBITDA, your PB, price to book value, price to earnings value, your PEG ratio, your price to sales, current ratio, debt to equity. Now, I'm just saying these out loud so you guys can get familiarized with these types of information. Okay, and a lot of this is supposed to be done in a class one-to-one where we can discuss it. Quick ratio, interest coverage ratio, operating margin, profit margin, ROE, ROA, ROIC, return on invested capital, return on assets, return on expenses. So there are a lot of different ways that we can look at a company's cash, and it's very important for us to understand what those different ratios are and how to use them. You're not going to use all of these ratios. You're going to use a mix of ratios depending on which industry a company is in. Those are the type of ratios you're going to be using. So let's jump into these ratios very, very quickly. EV over enterprise value over EBITDA. Essentially, at what multiple of earnings is the entire company valued at? EV over EBITDA is the most common metric used when doing comparable multiple analysis. That means if I'm going to look at various different companies, I want to understand that enterprise value divided by their earnings before interest. So if a company is valued at $100 million, but they earn $1 million in the last year, they're valued at 100 times their earnings. So varies greatly with industry. So we have to be very careful when comparing a tech company with a biotech company. There'll be very different metrics that are being used. So if the industry average EV by EBITDA is a multiple of 6x and your company has an EBITDA of 100 million, what is your company's EV, enterprise value, that you're looking at? So you can simply look at EV by EBITDA equals 6x, plug in the different ratios, and you can see where that company is trading at. So with a low ratio, company might be blank, right? This I want you guys to answer and think about. Higher EV over EBITDA ratio in dash growth industries like technology and biotech. So this is a lot of stuff that we discuss in class, in person. I don't want to get into that since this is a video recording, but let's move on. Your price to book ratio, the PB ratio, compares the cost of a stock to the value of the company if it was broken up and sold today. So PB is your stock price divided by your book value. What is your book value? Your book value is your total assets minus total intangible assets minus liabilities. Book value is a theoretical value of assets that would be recovered in the event of a total firm liquidation. So if the firm was to be sold off, what are the total assets, what are the total intangible assets, and what are the liabilities? Why are we subtracting out intangible assets and intangible liabilities? Because that is not useful for us. Only the total assets can be sold off in a liquidation event. So assume total assets is 10 million, intangible assets is 1 million, liabilities is 6 million, stock price is $21, outstanding shares is 1 million. What would be the price to book? You can calculate that out easily. This is also known as the price to equity ratio. So lower PB means that the stock could be undervalued or the company is in trouble. Again, it varies drastically by industry, and you must find the book value per share first, then divide that number into the stock price of one share. Alternatively, you can divide the market cap by the book value of the entire firm. Right, the answer to this is 7. So I want you to figure out how we reach the number 7. What is the price to book of 7 for this particular example over here? Your price to earnings is a very, very famous, and PE ratios are very, very commonly used. You cannot use them in isolation. None of these terminologies can be used in isolation. They need to be used, compared to each other, compared to companies, compared to industries. The PE ratio of a firm is a multiple at which the stock price is trading as compared to the earnings per share, your EPS. How much do you pay per dollar of earnings? Right, so if you think about it, I don't care which industry, I don't care which company, for that particular asset, how much am I paying for a dollar of earnings? So the PE ratio is the current stock price divided by your earnings per share. So if your stock price is 502.20, your earnings per share is 40.44, what is your PE? Once you find your PE, in isolation that means nothing. Right? You need to compare your PE now to what else you could buy or other companies in that particular industry to see who's giving you a better price per dollar of earning. So what do you do if you have a negative earnings per share? Right? Your high PE suggests that investors are expecting higher returns, higher earnings growth in the future compared to a company with lower PE. However, it could also mean that a high PE is that a firm is overvalued. Now, trailing PE versus forward PE is very important. Trailing PE means that historical earnings per share is being used, whereas forward PE means that your predicted earnings per share is being used. If I'm looking at trailing PE, it doesn't mean that what happened in the past is going to happen in the future. So I need to look at your trailing PE and the forward PE of the company by looking at investor analysis over what the expected earnings per share is to see where the price to earnings of that particular company is going. So your price to earnings to growth, PEG ratio, is very interesting as well. It's your price to earnings, your PE ratio divided by the growth of earnings over a specific period of time. So PE divided by EPS growth. It can be used in the past or in the future, trailing versus forward. Expected growth is almost impossible to forecast accurately, so take it with a grain of salt. Your PEG ratio takes into account the growth of earnings and helps to give a more complete picture of relative price. If our firm's PE was 15 and our annual EPS growth rate was 20, what would our PEG ratio be? Right? Now, the lower the PEG ratio, more the stock may be undervalued given its earnings performance. So a PEG ratio below 1 is desirable. Since this is an absolute ratio, it's going to tend to 1. Right? A price to earnings divided by growth. So if I have something below 1, that's going to be something that's desirable. If I have something higher than 1, the further away it deviates from 1, the worse you can assume that this stock is being priced at. But again, it's very, very subjective to what the other companies in that same industry are doing. Now, very quickly, your price to sales and enterprise value to sales. Price to sales is in TTM. Remember TTM, trailing 12 months. is your share price divided by your revenue per share. EV per sales is your enterprise value divided by your annual sales. How much it costs to buy the company's sales takes into consideration debt, while price of sales does not. If Google, right, Google, which is now Alphabet actually, generated 32 million in sales, has a market cap of 640 million, debt of 17 million, and cash on hand of 20 million, what are the PS and EV sales ratios? Right, this can be calculated out using the formulas above. And now a quick exercise you can do is use Yahoo Finance or Google Finance to go to and try to find two companies where price to sales is a good metric and two for which it's bad. Right? Now, lower enterprise value to sales might mean the company is undervalued. It can also signal that the future sales prospects are not very attractive. High enterprise value to sales, not necessarily a bad thing, as it can be a sign that investors believe that future sales will greatly increase. So other ratios very quickly are going to be things like current ratio, your current assets versus divided by current liabilities. What do we want? Do we want it to be high? Do we want it to be low? What does that really signal, right? If my assets divided by current liabilities, like assets can be liquidated to pay off liabilities, right? But we want to understand like liabilities may not be a bad thing. It could be long-term investment, long-term growth or potential. It could be investing in a new factory that hasn't been paid off yet that becomes an asset in the future. So there's a lot of different variations per company that you're looking at that are going to drive your investment decision. So debt to equity, your total liabilities divided by your shareholder equity. It indicates proportion of equity and debt the company is using to finance its assets. So debt to equity, a high debt to equity ratio generally means that a company has been aggressive in financing its growth with debt. This can result in volatile earnings as a result of additional interest expenses because you have to pay off the debt that you used to borrow to invest in your company. Capital intensive industries such as the auto manufacturing industry tend to have a debt to equity ratio above 2, while personal computer companies have a debt to equity ratio of under 0.5. Why? Because auto manufacturing companies have to borrow a lot of money to build very expensive manufacturing plants to build the cars that they need to sell to generate revenue. Whereas a computer company or a software company simply has to hire developers to create code at a very relatively low cost and then sell that on a monthly recurring sales basis, which gets to revenue much quicker. But the value of the software versus the value of a car is drastically different. Okay, so the quick ratio. Your current assets minus your inventory divided by your current liabilities. We're removing our inventories from our current assets and dividing that by our current liabilities. It's an indicator of a company's short-term liquidity. Inventory takes time to liquidate. So we want to remove that and say, okay, how quickly can I remove cash from the company? Your dollar amount of liquid asset. And remember that liquidity means how fast you can turn something into cash. Right, and the cash is the most liquid asset because it's already cash, and things that are desirable are definitely more liquid than things that are not desirable. So other ratios, valuation ratios are used to determine how a stock is valued in the marketplace. All the metrics described depend on the current price of the stock or the market cap of the company. The ratios are often swayed by market dynamics, which are not always accurate. So if a company CEO says something, the market may change the stock price, but that may not be accurate and may not reflect. Like, for example, Elon Musk smoked weed on a podcast, on the Joe Rogan podcast, and the Tesla stock price came crashing down. All the ratios changed. But that doesn't mean that that's accurately priced, because sure enough, a month after that, the stock price rebounded back, and then all the ratios changed again. So don't make all your investment decisions based on just the ratios. You need to take into consideration everything from the stock price to the ratios, to the relative ratios between companies and between industries. Efficiency ratios help us to look at the effectiveness of the company without the market's interference, which is very, very interesting. So your efficiency ratios are things that it allows investors to see how effectively a firm is using its resources. Return on equity, return on assets, return on invested capital. Right? So operating and profit margin. It allows us to see what percentage of each dollar translates to the company's bottom line. This is all independent of stock price, which is why it's so interesting. Operating margin is operating income divided by net sales. Gives us an idea of how well the management has been at generating income from the operation of the business. How much a company makes on each dollar of sales. Operating income includes all revenues, not just the sales. So profit margin, on the other hand, is net income divided by sales. How much out of every dollar of sales a company actually keeps in earnings. So the bottom line is your net income, right? When people say bottom line, they mean net income. Operating margin is a measurement of what proportion of a company's revenue is left over after paying variable costs of proportions such as wages, raw materials, etc. A healthy operating margin is required for a company to be able to pay for its fixed costs, such as interest on debt. It's always best to look at how operating margin over a period of time changes. We want to see how operating margin changes over time periods. And remember from the last lecture, operating income, EBIT, earnings before interest and tax, is equal to revenue minus cost of goods sold minus operating expenses minus depreciation and amortization. Alright, and profit margin is very useful when comparing companies in similar industries. A high profit margin indicates a more profitable company that has better control over its costs compared to its competitors. Profit margin is displayed as a percentage. 20% profit margin means that a company has a net income of 20 cents for every dollar of sales. So this is what an income statement looks like, and we can look through this income statement and find, okay, net sales was $32,479. Cost of sales was $21,000. Gross margin was $11,000. Now my operating expenses, total operating expenses comes down to 4,870. Right? My operating income then is 11,114 divided minus 4,870, which gives me 6,275. I remove the other operating expenses and I get income before provisions for income taxes. Right? Is now 6,895. And my net income, when I provision for income tax, I'm removing my projected income tax, is my net income of 4,834. So when you look at it in a very logical manner, top to bottom analysis, you see a bottom line net income. This makes a lot more sense. Alright, then I simply take my net income and I divide my net income by outstanding common shares, right? And what I see is that I get my earnings per share. Don't worry about basic versus diluted, we can talk about that later. ROE and ROA. So ROE is return on equity, whereas ROA is return on assets. Return on equity is net income divided by shareholders' equity. How much profit a company generates with the money shareholders have invested. So if shareholders have invested $10 million, how much money have you made from that $10 million? Return on assets. You guys are getting a very similar vibe here, right? Whatever I'm dividing by is what I'm using to generate what I am dividing to. So net income divided by total assets. How efficient management is at using assets to generate earnings. ROIC, return on invested capital. Net income minus dividends. Dividends are what is paid out to stockholders for being stock owners in the company, divided by total capital. How well capital is being used to generate profits. So use the balance sheet and income statements on the next slide to calculate our return on equity, assets, and invested capital. So guys, I'm going to display this up here. You can pause this slide. You can pause the video. What you can do is now take into consideration all of these different ratios. Net income divided by equity, net income divided by assets, and you can come up with the different metrics. So what we're going through over here is, so your net income statement, you have now your assets and liabilities. You can use these values to then generate your ratios that are going to be interesting for you to look at, and you can also find these ratios through investor analysis. So ratios in perspective. Ratios help to clarify investing theses. Yeah, it is important to use ratios and numbers to back up your thoughts about a company. There is no magic ratio. Learning which ratios work best takes time and experience. Ratios need to be compared horizontally to other companies and industries and vertically through time. The one thing you never use to decide on an investment is price. Do not look at just the stock price. Please, you must use ratios. You must use fundamental and technical analysis of companies to be able to understand whether you should or should not invest and give this company your money. Next time we're going to talk about is fundamental evaluation, macroeconomic analysis, microeconomic analysis, growth drivers, and a short intro to fixed income. Thank you guys for taking your time to go through all of this with us. We really appreciate your time through this. Hopefully it was very interesting. Make sure you drop a link to, you drop us an email and ask us for any links you might need, ask us for anything else that we can help out with. We're always here to help, and thank you guys for being campus ambassadors. We appreciate your time with WonUpIt, and we will see you at the next lecture. Take care. Bye-bye.